This is how to decide what market to invest in for your first or next real estate deal. Location, location, location. It's all we hear about in real estate. Choosing the right location to invest in can dramatically increase your appreciation and cash flow potential, helping you build passive income and retire faster. But the United States is so big. How do we find the best market? One that is appreciating, cash flowing, and affordable. If you look closely, many real estate investors are still finding desirable markets out of state. For some, it takes only 10, 5, or even one home run deal in these markets to reach financial freedom and retire early. But finding these markets to invest in takes time. It can feel like forever to analyze population trends, income values, and rent growth for a single market, let alone hundreds. What do these successful investors know that we don't? Is it talking to an agent in each market or buying high-end coaching programs? Maybe they use expensive investment softwares. Obviously, they know something we don't. We need to figure it out because the real estate investors that reach financial freedom know how to build their portfolios within growing markets years before these markets become the next big deal. Good news for us, it's actually quite simple and it doesn't require any fancy software or any high-end price coaching. To analyze a market follows a couple of steps, and this video will walk you through all of them. If you're new to this channel, welcome because you are home. And to be honest, we need you. Subscribers to this channel are real estate investors looking to build their portfolio and scale faster using technology. Before you ever research a market, you need to plan your strategy and risk tolerance because nothing feels worse than analysis paralysis, an endless search through data with no clear guidance, leaving you feeling more confused than when you began. If this is you, this likely means you do not have a clear focus on your goals. But don't worry, I've been there too. When I started investing out of state, I was working full-time as a data scientist. I had limited time to analyze markets, and each time I was close to choosing a single market, I would come across a new metric to analyze, leaving me to start from scratch all over again. I thought there had to be a better way. I started to refine my search based on my strategy and risk tolerance. By investing in my 20s, I had time on my side, so I favored appreciation over cash flow. It was more important for me to invest in a property in an up-and-coming area, knowing I can hold it for 30 years while it transitions to become the next hotspot. Once you have your strategy, it's time to define your metrics. My first key metric was year-over-year appreciation. I wanted to invest in an area that historically has consistent appreciation and more so in the last 5 years. My second key metric was vacancy rates. Since my cash flow would start off low, I needed to make sure I invested in an area with low vacancy rates. This would help avoid costs like tenant turnover. Another attribute that could help me increase my cash flow over time would be rising rents. Rents rise when there is more demand than supply. Therefore, I wanted to look at population and migration trends. These would help me to see if there's an influx of people moving to an area with perhaps low inventory. By having a strategy and defining my metrics based on it, I was able to narrow down on 3 key metrics: appreciation growth, low vacancy, and population growth. For a full list of metrics like economic and market data indicators, you can check out my cheat sheet in the link below. It has important metrics alongside the public links to find the data. Now that I had my strategy set and my key metrics, it was time for research. As a data geek, this was my favorite part and the one I was most excited about. But then my excitement all came crashing down when I realized, oh my God, the data is all over the place. I tried following methods from other real estate investors, but they were all super manual. I was fumbling through multiple spreadsheets and browser tabs with only analyzing a couple of markets. How would I be able to analyze the entire US? It seemed almost impossible. But this is where I thought, maybe I could use my data analytics skills. I've worked for top companies throughout my career, automating processes, building predictive models, and delivering actionable insights. Surely I could do the same with real estate. So I created a free market analysis tool to help you analyze real estate markets and decide where to invest using data. It combines data across multiple public sources for every metro area in the US. This helps to save you time from combing through data yourself. No more VLOOKUPs or pivot tables. The market analysis tool also has the ability to combine metrics, so you can rank areas on appreciation, population growth, and profitability all at once. Oh yeah, you can even have your own custom algorithm by weighting which economic and market metrics matter most. But before we get into that, let's dive into the key metrics and why they matter for real estate investing. First metric, appreciation growth. Appreciation growth refers to the increase in value of real estate property over time. It's like your savings account accruing interest, but instead of money, it's the value of your property that grows. This is important for real estate investors because it's a major way to make money. When you sell the property for more than you bought it, that difference is profit, and that profit comes from appreciation growth. Essentially, it's like buying something on sale and then being able to sell it for a higher price later on. You can find appreciation growth on the US Census fact sheet. However, this can be outdated by at least a year. To find more up-to-date data, you can find appreciation in Redfin's data center. Redfin provides data monthly, even down to the neighborhood level. Next metric, population growth. Population growth simply means the number of people in a population is increasing. This can happen due to more births than deaths or due to immigration. Population growth is a key factor in real estate investing for a couple of reasons. A growing population means more potential tenants or buyers for your properties, which can drive up demand and potentially rent or property values. You can find population growth on the US Census fact sheet. If you use their API, you can get as detailed as population growth by age, sex, and race. To review migration trends, I like searching for a city in Redfin's housing market page. You can see from the prior quarter where people are moving to and moving from, relevant to the location that you select. Now, household income. Household income refers to the total combined income of all the people living in a single house or residence. This typically includes income from jobs, pensions, Social Security, and even investment gains. Household income is important because it reflects people's ability to afford housing. In areas with higher median incomes, people can generally afford to spend more on rent or mortgages. This can influence rental rates and property values, making it a key factor for real estate investors. If you're looking to invest in rental properties, areas with rising household incomes could be a good target market. You can find median household income in the US Census Quick Fact Sheet. As well, you can find data on Fred's website. Here you can view year over year how household income has changed to get a better sense of where it is trending. Next up, rent. Rent refers to the periodic payment a tenant makes to a landlord for the right to occupy a property. It can be paid monthly, weekly, or even biannually, depending on the agreement. Rent is a crucial factor for real estate investors because it is the primary source of income. Ideally, the rent you collect should cover your expenses, like mortgage, property taxes, insurance, and maintenance, and leave you with a profit. Rent directly ties to how much cash flow or profit you will have from your rental. You can find rent for the prior month on Zillow's housing data page. You can even get more detailed by using Zillow's rental market trends. Here you can search for rental trends by city and even at the zip code level. Next metric, vacancy. A vacancy refers to a rental unit or property that is unoccupied and not generating income. There can be various reasons for a vacancy, such as tenant turnover, renovations, or lack of renters in an area. Vacancy is a major concern for real estate investors because it directly impacts your income. Every month a unit sits vacant, you're losing out on a potential rental income, which ultimately will reduce your cash flow. You can find vacancy rates by quarter on the US Census website. You can also check out apartment lists for vacancy by month. Wow, those were a lot of metrics, and if you stuck with me thus far, congrats. Now it's time for you to start researching and analyzing markets. Do you remember each resource and website link I just showed you? No worries if not. That's why I built the market analysis tool. It combines data across multiple sources. That way you can go straight into data analysis. No more opening 20 browser tabs at once or having 100 spreadsheets open at the same time. This tool makes it easy for you to analyze markets all in one place. Here's how to use the market analysis tool. First, select your key metrics based on your strategy. You can select multiple metrics at once. This will create a score that combines both metrics. That way you can consider metrics like appreciation and affordability at once, rather than isolating each metric. Once you select your metrics, it's time to weight them. I recommend having a total weighting of 1. The higher the weighting you put towards a metric, then the more it matters in your score. For example, if I care about appreciation more, I can weight it as 0.70 and affordability less so as 0.30. This will now update the top 10 metro areas on the right-hand side. The market analysis tool dynamically updates the score based on the metrics you select. We can use the filters below to focus on geographic region, population, and median listing price. For example, I can select a geographic region to only be Midwest. This will filter metro areas specific to this region. I can select any of the top 10 metro areas to learn more. I can quickly see top-level economic stats and even year-over-year trends, cutting down my analysis time from weeks to minutes. Now it's time for you to explore and find your next market. Once you find a market you wish to explore, the next step is to check out the properties behind them. After over 4 years of having this YouTube channel, I've learned what early-stage real estate investors need to save time and find a home run deal. I've combined everything I've learned and poured my heart into building a tool specifically for you. With Coffee Closers, you can dive into any market across the US and analyze deals based on your strategy. Feel free to check it out using the link below with a 7-day free trial. I'm excited to see what you are able to accomplish. And if you haven't already, please subscribe to my channel for more data insights in real estate and like this video if you want to see more content like it. Thanks.